Welcome to the Deep Dive. Today, we're plunging into, well, a really intriguing question in modern tech investing. Can a company that's genuinely a leader in this high-stakes, AI-driven cyber warfare world, can it actually achieve lasting profitability? Especially when, its own insiders seem to be consistently selling shares.
Yeah, that's the core tension, isn't it?
We're about to peel back the layers on SentinelOne Inc., that's NYSE, ticker SIEC, a fascinating player in cybersecurity for sure.
Absolutely. And this deep dive is all about understanding them. We've anchored all our financial data, market metrics, qualitative stuff, everything, to July 18th, 2025.
Okay.
Our goal today, really scrutinize the business, the leadership, the financials. Can that cutting-edge AI platform conquer both the cyber threats and that elusive goal of sustainable profit?
And just for context, the closing share price on July 16, 2025 was $17.72.
Right. So get ready for hopefully some surprising facts, maybe some aha moments for you listening.
All right, let's dive into the first big piece. Chapter 1, business analysis. How exactly does SentinelOne operate? How do they make their money?
Well, at its heart, it's a subscription model. Software as a service, SaaS. That's key.
Right.
Because over 90% of their revenue, it comes from those recurring fees.
Yeah.
For the platform, the updates, it's predictable.
And the other bit, less than 10%.
That's from professional services, things like incident response, security assessments. Important, but a smaller piece of the pie.
So that classic sticky sauce model.
Right.
And how do they reach customers? Big companies, small ones.
They actually use a multi-channel approach, aiming for, well, almost everyone, SMBs, large enterprises, government organizations, across lots of industries, finance, healthcare, tech. And a big part of this is their global network of channel partners and managed security service providers, MSSPs.
Ah, the MSSPs. So they bundle SentinelOne in?
Exactly. They resell it or manage it for their own clients. It expands reach massively.
Makes sense. Now, the tech itself, what are they actually selling? What's the core offering?
The core is their Singularity Platform. Think of it as an AI-powered brain for security. It's an XDR solution.
XDR, extended detection and response.
Right. It pulls data from everywhere, endpoints, cloud. Identity gives you one view and automates the response. That whole single pane of glass idea.
Okay. And it has different parts, modules.
Yes. The flagship is Singularity Endpoint. That's a protection and detection for your devices, laptops, servers, uses their patented behavioral AI, autonomous.
So it stops threats on the device itself. What about, cloud stuff?
Yep, that's Singularity Cloud, protects cloud infrastructure, workloads, CWPP, they call it containers, Kubernetes,
Right.
all that modern cloud environment complexity.
Kubernetes, right? The container city.
Yeah, a good way to put it. Then there's Singularity Identity. That came from acquiring Attivo Networks.
Oh, okay.
It defends against identity attacks. Think Active Directory, Azure AD, the keys to the kingdom for most companies. Real-time defense there.
And all the data flooding in. Security alerts are overwhelming. How do they handle that?
That's a huge pain point, you're right. They have Singularity Data Lake and AI-SIEM. SIEM tools, the traditional ones, be clunky.
Definitely.
SentinelOne's is a modern AI-powered backend designed to replace those old legacy SIEMs. Make sense of the noise?
And AI is woven through all of this.
Yes, absolutely. With Purple AI, it's like a generative AI security analyst built in, uses natural language, speeds up threat hunting, automates responses, a force multiplier for security teams.
Okay. And they offer services, too, like managed detection.
Right. Singularity, MDR, DFAR, for companies that want SentinelOne to basically run the show for them.
It sounds comprehensive. But how do they stack up? You mentioned giants like Microsoft, CrowdStrike.
Yeah, they're definitely an emerging challenger in that sense.
Yes.
They're up against heavyweights.
But still growing fast.
Oh, yeah. Significant scale. They're on track to cross $1 billion in annualized recurring revenue, ARR, during their fiscal year 2026.
Wow. Okay.
As of January 2025, they had over 14,000 direct customers. And get this, 1,411 of those were paying over $100,000 in ARR. So some big fish in there.
So for you listening, what's the bottom line value proposition here?
It really boils down to autonomous AI-powered security at machine speed.
Machine speed, meaning?
Meaning reducing reliance on humans, cutting down that dwell time, the gap between infection and cleanup, and lowering the total cost of ownership. Faster, cheaper, more effective security through AI. That's the pitch.
Okay, let's zoom out a bit now. Industry analysis. What's the bigger picture for cybersecurity in 2025? Is it a good market to be in?
Oh, absolutely. The tailwinds are strong. The global market was over $300 billion in 2025. projected to hit nearly $880 billion by 2034.
That's huge growth.
Massive. A CEG over 12.6%. Cybersecurity isn't optional anymore, it's fundamental.
And what trends are driving that demand?
Several big ones. First, the AI arms race. Attackers use AI. Defenders need AI. It's escalating.
Right.
Then the expanding attack surface, cloud migration, complex supply chains, more doors for attackers to knock on. We're also seeing the rise of zero trust. Basically, trust nothing, verify everything. It's becoming the standard approach.
Makes sense.
And finally, increasing regulatory scrutiny. Think GDPR, other data privacy laws. Companies have to invest in security to avoid massive fines.
So a booming market, clear drivers. But you mentioned competition. CrowdStrike, Microsoft, Palo Alto Networks, Zscaler. How intense is it?
It's incredibly intense. And here's a critical point. The financial disparity.
How so?
SentinelOne, despite growing fast, is still deeply unprofitable. Compare that to, say, Palo Alto Networks, highly profitable, massive resources.
Right, the numbers really show it. We looked at FY25 data. SentinelOne's market cap around $6 billion, $821 million revenue, but a negative 49% net margin.
Exactly. Then you look at CrowdStrike, $125 billion market cap, Palo Alto, $133 billion, positive margins.
And the price to sales reflects that, right? SentinelOne at about 7, CrowdStrike nearly 30.
Precisely. The market values profitability and scale. This resource gap means competitors can outspend SentinelOne significantly on R&D sales. It's a constant uphill battle for SentinelOne's path to profitability.
But there are some positives. Regulatory tailwinds, maybe?
Yes. One big one for SentinelOne specifically is achieving FedRAMP high authorization.
The government certification.
Exactly. That opens up the very lucrative U.S. federal government market. That's a big potential growth area that was harder to access before.
And it's not an easy market to just jump into, right? What are the barriers to entry?
They're formidable. You need immense technological complexity. Building effective AI security takes years, tons of data. Brand trust and reputation are paramount. One big breach can kill you.
True.
Data scale and network effects matter hugely for AI. More data, smarter AI. Incumbents have a big head start there. And building those enterprise sales channels, that takes serious time and money.
Okay, so given all that, where does SentinelOne's competitive advantage really lie? What makes them stand out?
Well, their brand has strength, especially with technical folks. They're a leader in the Gartner Magic Quadrant for endpoint protection platforms 5 years running.
That's impressive.
And their performance in ITER ATT&C Chi tests on 100% detection gives them serious technical credibility. The tech works.
And financially, any cost advantages?
As a software company, yes, high gross margins.
Wow.
Around 74% GAAP, 79% non-GAAP in FY25. That's healthy.
Yeah.
But operational scale for profitability isn't there yet. Operating expenses, sales, marketing, R&D are still eating up more than those gross profits.
So good unit economics, but the overall engine is still burning cash. What about stickiness? Switching costs?
They're moderate but growing. Ripping out and replacing a core security platform is a major project for any company.
Right, disruptive.
And SentinelOne is trying to deepen that moat with things like the Singularity Data Lake module. Get more embedded, make it harder to leave.
But if you had to pinpoint their one unique asset, the core differentiator?
It has to be their patented behavioral AI engine and that autonomous response capability. They have, 147 registered patents? The core message is, our AI stops threats at machine speed, often without needing a human to intervene. That's powerful. In this AI arms race, fighting AI attacks with AI defense automatically is a key edge.
So not just seeing the fire, but putting it out instantly.
Yeah.
But is that edge sustainable? You hear AI is becoming table stakes.
That is the multi-billion-dollar question, isn't it? Their AI is strong now, but CrowdStrike, Microsoft, Palo Alto, they're pouring billions into their own AI.
So the lead could evaporate.
It could become transient, yes. SentinelOne needs to keep innovating incredibly fast just to stay ahead, or at least prove their specific way of doing AI remains superior. It's a constant race.
Okay, let's shift focus. Chapter 2, Management Evaluation. Who's running this show and how are they doing?
The company is led by co-founder Tomer Weingarten. He's been CEO since 2013, chairman since 2021. So stable leadership, consistent vision.
And how's he viewed?
Very well, it seems. High employee approval on comparably like 94 out of 100. The rest of the exec team is seasoned too, bringing experience from major tech players.
They faced some real tests in 2025, didn't they?
Wow.
How did management handle those crises?
They did. Two big ones. First, that June 2025 global outage of their management consoles.
Right, that sounded bad.
It was disruptive. But importantly, it was a software flaw, not a cyber attack. Management was quite transparent, put out a detailed root cause analysis, and stressed that the endpoints themselves remained protected.
Okay, so they owned it. And the other one, with Chris Krebs.
Right. April 2025. Chris Krebs, the former CISA director who joined them, resigned after an executive order revoked his security clearance. A tricky geopolitical situation.
Yeah, how do they navigate that?
They managed to frame it carefully. Krebs basically said it was his fight, not the company's, which helped isolate SentinelOne from the direct political fallout. Seems like decent crisis management in both cases.
And general communication. Transparent. Any red flags?
Seems pretty standard for a public company. Regular earnings calls, detailed reports. That technical breakdown of the outage suggests a leaning towards transparency. We haven't seen evidence of major ethical scandals.
Good. Now let's talk capital allocation. Where does the money go? What are their priorities?
Historically, aggressive growth, full stop. Huge investment in R&D, over $72 million in just the quarter ending April 30, 2025. And their acquisition strategy reflects that too, always aimed at broadening the Singularity Platform. Scalar for data analytics, $155. Attivo for identity, $616.05. PingSafe for cloud protection, over $100. Even Krebs Stamos Group for advice. All about building out that platform.
But something changed recently, right? A shift in strategy.
A pretty significant one, yes. In May 2025, they authorized their first ever share repurchase program, up to $200 million in buybacks.
That's about 3.3% of their market cap. Why now?
The company said they believe the stock is undervalued and they want to offset dilution from stock-based compensation. It signals a potential shift towards a more balanced approach, maybe thinking more about shareholder returns beyond just pure top-line growth.
Interesting. But how effective has all this past investment been? What about return on invested capital, ROIC?
Yes, ROIC, it's not good. Consistently and deeply negative. We're talking negative 13% to nearly negative 28% for the trailing 12 months.
And their cost of capital, the WACC?
Around 6%. So ROIC is way, way below WACC. Meaning, historically, they've been destroying economic value, spending more on growth than the returns that growth is generating, at least so far. The trend is improving slightly from worse losses, but they're still firmly in value-destructive territory based on this metric.
Okay, that's a stark picture on ROIC. Now let's get deeper into the numbers. Chapter 3, Financial Analysis. What do the core financials tell us?
All right. Market cap, as we said, around $6.1 billion.
And revenue growth. You mentioned deceleration.
Yeah, that's the big story here. Historically amazing, triple digits in FY23, 106%. But then FY24 was 47%, FY25 was 32%, and the projection for FY26, low 20s.
So a hyper-growth phase seems over.
It certainly seems to be moderating significantly. That's a key concern for a company priced for growth.
What about profit margins? Any light at the end of the tunnel?
Well, the gross margins are good. Strong and improving, 74% OP, 79% non-GAAP in FY25. That shows the software itself has value.
But operating and net margins?
Still deeply negative. Operating margin was negative 40% in FY25, net margin ended at 35%. All that spending on sales, marketing, R&D, it's hefty.
And that Q1 FY26 net loss of 91%, that sounds horrific.
It does, but context is key there. That was heavily driven by a one-time tax provision. An accounting thing, not really reflective of ongoing operations burning cash that badly, but it hits the GAAP bottom line hard.
Okay, understood. Now that crucial point, free cash flow FCF, you said it turned positive, but there's a catch.
Exactly. This is critical. After years of burning cash, they hit positive FCF in FY25, 1% margin, and the latest quarter was strong, 20% margin.
Sounds great. Inflection point.
Hold on. Here's the big asterisk. That positive FCF is primarily driven by non-cash stock-based compensation, SBC.
Explain that. How does SBC make cash flow look positive?
So SBC is an expense on the income statement, but it's not actual cash going out the door in that period. When calculating FCF starting from net income, you add back non-cash expenses like SBC. If SBC is huge, it can push your calculated FCF into positive territory, even if the core operations aren't truly generating surplus cash yet.
So for listeners trying to gauge real profitability,
Yeah.
this FCF number might be misleading.
It can be, yes. From an owner earnings perspective, what's truly left for shareholders, after all, real costs, including the eventual cost of that stock dilution, they likely aren't generating truly positive cash flow from the business itself yet. They're often using cash from operations to buy back stock issued as compensation. It's a bit circular.
Got it. A very important nuance.
Yeah.
What about overall financial stability? Balance sheet.
Despite the losses, the balance sheet is actually very strong. They're effectively debt-free, 0.0000 debt to equity as of April 2025. Plenty of cash.
And short-term liquidity.
Robust. Current ratio of 1.75, no near-term solvency issues, and obviously no dividend. They're reinvesting everything.
Okay, so all these numbers lead to valuation analysis. How do we value a company like this? PE is useless.
Right, negative earnings, so no PE. We look at price to sales, PS. It's around 7.09.
How does that compare?
Well, it's way below CrowdStrike's nearly 30, but still above the broader U.S. software industry average of about 5.5x. So the market gives them some premium for growth, but clearly factors in the unprofitability and risks compared to peers.
And intrinsic value, using DCF, discounted cash flow.
Yes, we ran some educational DCF models. Briefly, you forecast future free cash flow, estimate a terminal value way out, and discount it all back to today's value.
And the result, what's the estimated range?
The models spit out an estimated intrinsic value range of $21.56 to $33 per share.
That's a very wide range. What drives that uncertainty?
It's highly sensitive to assumptions. These models used a two-stage growth, high growth initially, then slowing to a terminal rate around 2.3, 2.5%. The discount rate used was 6.7% to 6.9%.
6.7% to 6.9% a discount rate. That sounds low for an unprofitable tech company, doesn't it?
That's the key caveat. It does seem relatively low given the risks of unprofitability, competition, execution challenges. If you used a higher, arguably more conservative discount rate, that intrinsic value range would come down significantly. So take that $21, $150, $33 range with a big grain of salt regarding that discount rate.
All right, good context. Let's pivot now to Chapter 4. Market sentiment. What's the vibe out there? What does Wall Street think?
Wall Street analysts. Generally positive. The consensus is a buy, with a good chunk of strong buy ratings, too. About 56% are buy or strong buy.
Only 4% sell.
Yeah, very few outright bears among the analysts covering it.
And their price targets, where do they see it going?
The average 12-month target range is $22.65 to $24.83. That implies, potential upside of 28% to 40% from the current price, around $17.72.
You mentioned divergence earlier.
Huge divergence. Individual targets go from $15 all the way up to $38. That tells you there's really no strong agreement on the near-term value, even among the bulls.
Oh, interesting. What about the media? General news flow. Is it all positive?
It's definitely mixed. News coming from the company, usually positive. Tech wins, Gartner status, AWS deals, fighting off cyber attacks. Good stuff.
But financial news?
More cautious. Lots of focus on that slowing growth, sales execution hiccups they mentioned, disappointing guidance. We've seen analyst downgrades recently and negative headlines from that service outage back in June.
So, a disconnect. Analyst price targets are up here, but the market chatter and financial news are more grounded, maybe even skeptical.
Exactly. A clear disconnect between analyst optimism and broader market sentiment or skepticism.
Okay, let's look at some specific market indicators. Short interest. Are people betting against it heavily?
It's moderate, around 4.5% to 4.7% of the float shorted. That's about 14.5 million shares. The days to cover is low, 2.2 days. Meaning there's some bearish sentiment, but it's not overwhelming, and there's no real risk of an imminent short squeeze. It's not a major short target right now.
And the stock's technical picture. Moving averages.
Not looking great technically. It's trading below its 50-day moving average, which was around $18.50. That suggests short to medium-term weakness.
And long-term.
Also trading significantly below its 200-day moving average, around $21.70. That indicates a sustained downtrend over the longer term. So the price action itself is bearish right now.
Okay, this brings us to a really crucial part. Chapter 5. Ownership structure. Who owns SentinelOne? And more importantly, what are the insiders doing?
Ownership is heavily institutional. About 82% of the shares are held by big institutions. We're talking Vanguard, BlackRock, Insight Holdings, Celebra Capital, major players.
Concentrated.
Quite concentrated, yeah. The top 21 shareholders control over half the company. So management is definitely accountable to these large investors.
But what about the insiders themselves, management founders?
That's where it gets really interesting. Insider holdings are relatively low for a tech company like this, maybe 2.0% to 2.7% total. CEO Tomer Weingarten holds about 1.5%.
Okay. And their trading activity, buying, selling.
Overwhelmingly one-sided,
Yeah.
selling. Consistent, widespread selling by top executives over the past year. Virtually zero open market purchases.
Wow. Any recent sales?
Yes, there were sales in June 2025 around the $18.30 mark.
So let's unpack that. We have high institutional ownership. Smart money supposedly likes it.
Right.
But the people running the company with the best information, they're consistently selling. How do we square that?
That's the major contradiction here, and a significant red flag for potential investors. You could argue personal financial planning, diversification.
Sure, people sell for lots of reasons.
Right. But when it's this consistent, this widespread across the executive team with no corresponding buys, it strongly suggests that management, despite the public bullishness, might not believe the stock has significant near-term upside from current levels, or at least that they see better places for their own capital. It raises serious questions about their conviction compared to Wall Street analysts.
It's like they're voting with their feet or their wallets. A very important signal for listeners to consider.
Absolutely critical. Actions often speak louder than words, especially when it comes to insider transactions.
Okay, given all these factors, let's systematically assess the situation with Chapter 6, Risk Assessment. Let's do a SWOT analysis. Strengths, weaknesses, opportunities, threats. Start with strengths.
All right. Strengths. Definitely their advanced AI tech, the Gartner leader status, unitary performance, that technical credibility is real. High software gross margins, around 75%, is a plus. And that strong balance sheet, over $1.1 billion cash, virtually no debt, gives them staying power.
Solid foundation in tech and finances. Now, the weaknesses. What holds them back internally?
The big ones. Chronic unprofitability, never made an annual GAAP profit, big losses, negative RAC. Sharply decelerating growth is a major concern now. And as we just hammered home, that persistent insider selling.
Clear weaknesses. But the market is huge. What are the main opportunities ahead?
Massive opportunity in the large, expanding cybersecurity market itself, double-digit growth. Huge potential to upsell and cross-sell more modules from the Singularity Platform to existing customers. Disrupting the legacy SIEM market with their AI-SIEM is a big prize. And that FedRAMP high authorization unlocks the large U.S. federal market. Lots of avenues for growth.
Seems like plenty of runway if they execute. Now, the threats. What external factors could trip them up? General threats first.
Number one is intense competition. CrowdStrike, Microsoft, Palo Alto. Bigger, profitable, pouring money into AI. That's huge. Technological obsolescence is always a risk if they fall behind. And the ever-present threat of reputational damage from a security breach or another major operational failure like the June outage. For a security company, trust is everything.
What about broader macroeconomic threats?
Management themselves have flagged this. Economic uncertainty leading to longer sales cycles. Customers might opt for cheaper, bundled deals from the big guys in tough times, and higher interest rates just generally make unprofitable growth stocks less attractive valuation-wise.
And geopolitical risks, beyond just general cyber warfare.
Yeah, increased risk from sophisticated nation-state attackers is constant. Hypothetically, things like tariffs on hardware could impact them. And we saw direct political risk with the Chris Krebs situation that can affect personnel, government relations, clearances. It's a factor.
Okay, we've covered a huge amount of ground. Let's bring it all together in Chapter 7, Conclusion. Can you synthesize this into a clear bull case and bear case?
Sure. The bull case looks like this. SentinelOne is a tech leader in a critical, fast-growing industry. Their AI-native platform fits perfectly with where cybersecurity is heading. They're still small relative to the total market, so lots of room to grow. Financially, they seem to be at an inflection point positive FCF with caveats, improving operating leverage. There is a visible, though maybe distant, path to profitability.
Okay, that's the optimistic view. Now, the bear case. What are the main arguments against the stock?
The bear case is potent. Chronic unprofitability, never a GAAP profit, deep losses, negative ROIC, intense competition from giants with far more resources, sharply slowing revenue growth, and arguably the biggest red flag, that relentless, widespread insider selling, which completely contradicts the bullish story.
So let's revisit the valuation summary. Where does the stock price sit relative to your analysis?
Our educational DCF models gave that wide range of $21.56 to $33 per share for intrinsic value.
And the current price is $17.72, which is below the low end of that range.
Yeah.
So potentially undervalued.
Potentially. But that potential hinges entirely on whether you believe those long-term cash flow forecasts and trust their ability to navigate all those risks we discussed.
Right. The low discount rate assumption in the DCF is key too.
Exactly. The wide DCF range itself shows uncertainty. Combine that with the clear bearish factors, no profits, tough competition, insider selling, and you need significant caution. The market isn't stupid. It's clearly pricing in a lot of execution risk here.
So the final outlook.
Look, there's undeniable upside potential if management executes flawlessly on very ambitious goals, but the path forward is fraught with challenges and significant risks. It's definitely not a slam dunk.
So what does this all mean for you listening? In this world where AI is both the ultimate shield and the ultimate sword, can SentinelOne's impressive technology overcome the market's hunger for profits now? And maybe more importantly, overcome those concerning signals coming from its own leadership? That's the question to wrestle with.
And if you want more deep dives like this one, definitely like and subscribe to the Stock Analytics AI YouTube channel. For our Stock Analytics AI members, it's just €4.99 a month. You get priority deep dives on specific tickers. We're actually covering all the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses.
Yeah, great value. And if you just want a one-off deep dive on a company you're curious about, you can always drop us a super thanks right here on YouTube.
And please remember, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice.
That's right. Please do your own research, or better yet, consult with a qualified financial advisor before making any investment decisions.